Okay, maybe we should start. Maybe there's still some more people coming, but welcome everybody. Before we go from very happy to welcome everybody here to the Finance and Society cluster, which is run jointly by Walter and then also Pierre and myself. And we're very happy to have Colin Mayer today. His official title is Professor Emeritus. Now, I didn't know, I always thought that academics never because once an academic, you're always there. But okay, I'm not going to read your CV because I'm not going to take away time from your seminar. So, but just to say that we've worked for many, many years at Oxford University, Colin also worked there. I think you were in G at some point, and Colin has published widely in banking, corporate finance, governance, so all these fields. And I see also that you have changed the title of the presentation. At least from what I saw, purpose, finance, and regulation, although I think it captures already in the previous title list. Now, Walter was just suggesting that we go very briefly around the table to introduce ourselves. Okay, well, I can start. I'm Thorsten Beck. I'm the director. I'm professor in the Robert Schuman Center, and I'm director of the Joint School of Banking and Finance, and I'm an economist. Right, Vanessa.
Hello, everybody. I'm Vanessa Villanueva. I'm a visiting fellow at the Max Weber program, and I work at the intersection of corporate law and technology.
Hi, I'm Moritz Wasso. I'm a new Max Weber fellow here at the STG, at the School of Transnational Governance, and I'm working broadly on regulation, competition policy, and the regulation of public utilities.
Hello, everybody. I'm Alexis Godelier. I'm a visiting student here, so discovering research pretty much.
Hi, everyone. My name is Alexis Emilia, and I'm a third-year PhD researcher in law here at UI, and I'm working on the intersection between corporate governance and sustainability.
Hello, everyone. My name is Arianna Vitanto. I'm a first-year PhD researcher here at the UI, and my research interests are mainly related to how blockchain and ERPs are shaping financial market regulation right now.
Hi, my name is Niklas Negler. I'm also first-year PhD researcher here at UI in the SPS department, and I'm thinking that I'm going to be working on public green investment at company as well.
I'm a Max Weber fellow at the Robert Schuman Center, and I work on European public finance and financial regulation. At the moment, mainly insurance and off-balance sheet policy.
Hi, I'm Bart. Sorry to be a bit late. I was in the wrong villa. And I'm a 48 PhD student here, and I work on housing finance.
And Marta Scherl, joint chair of Robert Schuman and Political Science Department, and I'm a professor of European policy. I should also say, Juliana, who's here in the background, she has supported us throughout this research project. Good things. So, then without further ado, we would like to begin talking.
Well, thank you very much indeed for the very kind introduction and for inviting me to be here this afternoon. Thorsten, so it's a great pleasure to be able to do it. So I'm going to be talking about a topic that has, I think, gained increasing significance and importance. Business and banking and finance in particular are going through a period of profound change. The sort of change that one perhaps observes every 60 or so years. And what underpins this is the fact that business and finance are seen to be incredibly important parts of our lives. They clothe, they feed, they house us, they employ us, and they invest us in. They're a source of economic prosperity, alleviation of poverty, and growth of nations around the world. But at the same time, they've been a source of increasing environmental degradation, biodiversity loss, inequality, social exclusion, and mistrust. And every year, for the past 40 years, the market research company, has undertaken a survey of 1,000 people in Britain about which professions they trust to tell the truth. And I'd just like to start this session off with a little survey of you. As to which of these professions do you think people most trust to tell the truth? Could select one of them amongst bankers, business leaders, civil servants, clergy, priests, journalists, lawyers, police, politicians. Let's quickly go around the room. Who would vote for banker?
Yes, that's it.
Who would vote for business leader?
I think what.
No, what you personally. You personally. Who would vote for civil servant? 1, 2, 3. Who would vote for clergy and priests? Who would vote for journalists? Lawyers? Oh, 1 for journalists?
Yeah.
Lawyers.
Me too.
Sorry, you're on lawyers.
No,
Journalists. Who would vote for lawyers? Police? Politicians?
No, I was just my hand.
Professors? Oh, okay. So we've got 4 for civil servants, no, 3 for civil servants and 4 for professors. Who hasn't voted? All right, okay. Well, the answer is those of you who voted for professors are quite right. Amongst the group that I mentioned, I'm pleased to say that professors come near the top, alongside teachers, doctors, nurses, etc. So although we haven't got much power, pay, or prestige, at least people trust us to do nothing, earn nothing, and take no credit for it. So at least we've got something going for it. In terms of civil servants, they come sort of midway. But as you can see, business leaders and bankers come near the bottom. They come just ahead of estate agents, journalists, advertising executives, and rock bottom, of course, come politicians. Now, this is something that I'm going to be emphasizing quite a lot, in particular in relation to banking and finance, because banking and finance are 2 sectors which depend particularly heavily on trust and trustworthiness. I'm going to give another quick poll. Which of the following countries do you think have the lowest levels of trust in their business? Argentina, Brazil, Colombia, Italy, Kenya, Malaysia, Nigeria, Spain, UK, US. Which of those do you think would have the lowest level? Argentina? Brazil? Brazil got 1. Colombia? Italy? Kenya? Malaysia? Nigeria? 1, 2, 3, 4. Spain? UK? USA? Okay, so Malaysia and Nigeria and US, I think, got the greatest number of votes. Well, great to say none of them got that. The answer is okay, the answer is the UK. It comes near the bottom of the Edelman Trust Barometer of 28 countries in the world. And rather interestingly, what you see is that levels of trust in developed countries, Europe and the US, are pretty low in comparison to those in developing and emerging countries. And we might all have our various views as to why that's the case, but that seems to be what people feel about business in different countries. But it also brings out an important element in terms of the extent to which business is trusted in relation to other institutions. I mentioned that business is at least more highly regarded than government in the UK, and that's what the Edelman Trust finds for business around the world. It's rated somewhat higher than NGOs, government, or the media. And furthermore, there's an important difference depending on the ownership of companies. And also, what is observed is that people tend to trust their employers more than they trust business in general. There's a higher level of trust that people have in their own employers than they have in business leaders in general. And furthermore, there's a higher level of trust depending on the ownership of companies, in particular in family, relative to the level of trust in other privately held companies or in publicly traded listed companies or than in state-owned companies. So what this is saying is that there is an overall low level of trust. Business people tend to trust their employees more than they trust business leaders in general. That there's a surprisingly low level of trust in business in developed countries, and a particularly surprisingly low level of trust in business in the UK. And I'll be coming back and talking about that in just a minute. And that there is more trust that people tend to have in family-owned businesses than in other, and ownership seems to matter in this regard. Now, what underpins this low level of trust in business is, I think, the very reason why business exists, the reason it's created, its reason for being, what is described as being the purpose of business. And as you'll be aware, the traditional view about the purpose of business, as it's currently expounded, was set out by Milton Friedman some 60 years ago, something known as the Friedman Doctrine, after Milton Friedman, the Nobel Prize winner. He said that there is one and only one social purpose of business: to use its resources and engage in activities designed to increase its profit, so long as it stays within the rules of the game. By which we mean engaging in open and free competition without deception or fraud. Now, that notion that the only social responsibility of business is to make money is something that is now the basis of business education, business policy, and business practice around money. But it's not the way in which business was traditionally viewed. Corporation was established some 1,000 years ago in ancient Rome as the socialist task of economies to undertake very public functions of collecting taxes, minting coins, and building and maintaining public buildings. And for nearly all of its 1,000-year history, business has combined both a public social function as well as a commercial function of making money. And it's really only over the last 60 or so years that this notion that there is one and only one responsibility of business to make money has arisen. And that is increasingly being associated with what we observe as the negative elements of business in terms of environmental degradation, biodiversity loss, inequality, and social exclusion, not to action that mistrust. But things have changed. 5 years ago, the CEO and president of BlackRock, the largest asset management business in the world, said that every business needs to have a purpose, not a strapline or a marketing campaign, but a statement of its fundamental reason for being, what it does on a daily basis. Purpose, he said, is not the sole pursuit of profits, but the animating force for achieving. And that notion that there is a purpose for business beyond just making money began increasingly to take force amongst the way in which business leaders looked at that purpose. But that became associated with the ESG and a sense that companies were simply using purpose statements as a way of trying to project themselves in terms of being socially beneficial, doing lots of good things at the same time as they were making money and going on making money in the traditional way for their investment. But increasingly, a notion has gained traction, both in academia and in business practice and policy, that looks at the purpose of business and financial institutions in a rather different way. And that is in terms of business and financial institutions being there to solve problems. To solve problems that you and I face as individuals, societies, and the natural world. And what business and finance has as a challenge in doing that is it's not about charity, it's not about philanthropy, it's about hard-nosed business. And therefore it has to be profitable and financially value creating, as well as helping to solve problems of other people. And so a way of thinking about what a purpose of a business or a bank or an asset management firm is that it's there to solve problems of people and planet in a profitable way, to produce profitable solutions for the problems of people and planet. And furthermore, not to profit from creating problems for either people and planet. Now, the importance of that notion of business and banking and asset management and other financial institutions being there to solve problems and to solve problems in profitably and financially valuable ways is that it creates a notion of what a profit is, namely it should derive from solving, not creating problems for others. And that's going to be very important when we think about the role of regulation in the context of financial institutions. That a fundamental purpose of business and a fundamental purpose of financial institutions is to think about themselves as being there to solve problems of others and to profit from doing that without profiting from creating problems for either. Now, this notion of a profitable, value-enhancing, problem-solving business and financial sector is not woolly. It's not just about ESG, environmental, social, and governance factors. It's not even just about corporate social responsibility. It's about what the driver of a business is. It's a framework within which the strategy and the core of a business and the core of what a financial institution is there to do should be thought about. And I want to illustrate it, and I want to illustrate the significance of some factors, including regulation, in relation to an example. And I'm going to start off with an example of a company that's not in the financial sector, but was established in 1936. In 1936, Henry Wellcome died and left the company that he created, not to his children, but on the foundation. And that foundation grew to become what is known as the Wellcome Trust and the Wellcome Foundation, one of the largest and most successful foundations in the world, which is basically funded research in universities around the world, in particular in regard to scientific research. And his company, the Wellcome Pharmaceutical Company, then grew and flourished until in 1986, the Wellcome Foundation decided to start selling shares in the company on the market. And eventually in 1990, it sold the last block of shares it had to another pharmaceutical company called Glaxo, to form Glaxo Wellcome. And then Glaxo Wellcome in 2000 merged with SmithKline Beecham to form GlaxoSmithKline. And so one of the largest pharmaceutical companies today, GlaxoSmithKline GSK, was formed from initially this company, which was owned by a foundation. Now, what's interesting about this is that many companies have foundations, but this is a company that was actually owned by its foundation. It's what is termed an enterprise foundation. Now, there's one country in the world where enterprise foundations are particularly common and widespread. Any ideas as to which country that might be? Torsten, why don't I ask you? Italy. Sorry, Italy? Who? Italy? No. On the contrary, Italy is a good example of precisely where foundations don't. Any other idea? No. 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 Denmark.
Oh.
It's a country that happens to have one of the highest GDPs per capita, lowest levels of inequality, best employee relations, and it's one of the happiest countries in the world. It also happens to have the largest proportion of companies listed on its stock market. So these aren't just small companies. These are listed companies traded on the Danish and often on the New York Stock Exchange as well, which have as a dominant owner a foundation, a charitable foundation. Now, this form of ownership has been associated with even more successful businesses than the family-owned companies around the world, which are plenty. In fact, the largest form of large company ownership is in families around the world. These companies are not owned by families, they are owned by foundations. And it just so happens that Denmark is also the home of what is now the most valuable company in Europe. Another pharmaceutical company, but not Beecham or GlaxoSmithKline. It's a company which I referred to in my talk this morning called Novo Nordisk. Makes insulin, but in the process, trying to solve problems of diabetes, it stumbled across a weight-losing drug called Wegovy, which has become a blockbuster drug. So it is home to some of the most valuable companies in the world. It is also the home to one of the most successful economies. And an underlying feature of that country is this dominance of ownership by a large shareholder, where that large shareholder isn't just a family, it's a foundation with a philanthropic objective. Now, I'm emphasizing this because what this is bringing out is something that is incredibly important in understanding regulation and law. And that is that much regulation around the world is associated with promoting the interests of, quote, minority investors, minority shareholder investors. That is to say, small investors like you and I invest a bit of money in the stock market, but we're nowhere near having a significant controlling influence on companies. And much investor protection is associated with trying to protect those investors from exploitation by large investors or by the management of companies. Now, one of the implications of that is that it emphasizes the significance of small investors relative to large blockholders. What Denmark has got, which has made the foundation ownership very successful, is a specific regulation that oversees these foundation-owned companies to ensure that they don't exploit their position or their tax privileges, but act in the interest of the companies that they control and act in the interest of the country as a whole. And that notion of thinking about not just how does one protect minority investors from exploitation by large investors or by management, but also thinks about how does one promote, engage large blockholders of shares. In this case of Denmark, where they are actually promoting a philanthropic objective as part of the foundation's objectives, how does one actually encourage that type of ownership of companies? And it's important to appreciate the significance of this because what it implies is that we need to think carefully about the nature of the ownership of companies and the way in which regulatory systems affect that, because it has a profound effect on the extent to which companies really do see their purposes as being to solve problems properly for the benefit not just of their investors and the minority investors, but for the benefit of other stakeholders in the world as a whole. Now, what I want to do is to say a little bit about what it takes for companies to be able to do this type of exercise. And I want to talk about a framework that we've developed in Oxford to help both institutional investors and the boards of companies to actually implement these notions of problem-solving profitable purpose. And we've developed a framework which we call the SCORE framework, where the word SCORE is an acronym for the 5 key components of what it takes to do this well. The first letter, S, is about simplifying the company's purpose so that it's really clear what problem the company is there to solve. Okay, so for example, in the case of a pharmaceutical company, it's what particular health issue is it really there to try and solve? Novo Nordisk is a very wealthy company in Denmark, has as its purpose to defeat diabetes around the world. And it came to that notion of its purpose after thinking about what it was really there to do very carefully. The second element is to link that purpose to the company's strategy. So it's the overarching framework within which the strategy of the company lies. The third letter, O, is the ownership of the company. Ownership in the sense that I was just talking about, in terms of owners who are really there and supported in terms of promoting a problem-solving purpose for a business, that are there for the long term. And one of the reasons why families are so prevalent around the world as owners of the largest listed companies, not just of small family businesses, they are the largest owners of large listed companies, is that they are long-term engaged investors. Families pass on the ownership of their firms typically from generation to generation. They have a long-term engaged interest in promoting the success of the company. The foundation-owned firms in Denmark, they are holding these companies that the founders of the companies have given to them in perpetuity. Therefore, they too have a long-term interest in promoting the purpose-driven objectives of those companies. So ownership matters in a formal sense in terms of who are the dominant owners of the share of the company, and therefore who are the owners who are establishing what the purpose is and ensuring that that purpose is really. But it's also ownership in terms of a sense of ownership by everyone in the organization, from the board to the shop floor. Everyone needs to feel that they've bought into the notion of problem solving. Otherwise, something that is just regarded as being management speak and promotion, but it's not got to do with the real business and embedding it in the strategy and the core activities of business. So it has to be owned by everyone in the organization, appreciating their ownership of the corporate purpose. The fourth letter, R, is about reward. About not only ensuring that the values and the culture of the company or the financial institution or the bank are aligned with the purpose, but also that the financial incentives are aligned. So that people in the bank or company recognize that their financial return, their pay, their salaries, their promotion, depend on their contribution to delivering on this problem-solving purpose. And that means the company has to measure its performance against the extent to which it's really delivering on this. The final letter, E, is to example, to bring the purpose to life so that everyone feels that the company is really authentic in seeking to adopt this problem-solving purpose. So that the management talks about the success of the company in delivering on its problem-solving purpose, but not only the success, but also the failure, the problems and the challenges they face in implementing that purpose. Now, those 5 elements together are critical to really ensuring that companies adopt purposes that are meaningful in the sense that they are profiting from solving, not creating problems for others. And I want to illustrate this now in relation to what is one of the most successful banks in Europe. It's a bank that needed no bailing out during the financial crisis in 2008. It needed no government support. It's one of the most highly ranked banks in the world. It has one of the highest credit ratings of any bank during the crisis, since the crisis. It has strong and persistently strong liquidity and capital ratios during and since the crisis. And it's been able to support and go on supporting its customers throughout the economic cycles of booms and busts. And it's a bank that has as its objective to being one of the banks with the highest levels of customer satisfaction of any bank. And also not just being a bank that is respected by its customers and trusted by its customers, but also a bank that is very successful in terms of its financial performance for its shareholders. So it likes to ensure that it has one of the lowest cost bases of any of its competitive banks. And it's been successful in doing this over decades. Now, this isn't just a short-term financial success in a financial institution. This is a long-term success. It so happens that it's also one of the fastest growing banks in Britain. But it's not a British bank. It's the Swedish bank, Handelsbanken. And one of the features of Handelsbanken is that it has one of the highest levels of customer satisfaction of any bank in relation to its, certainly its UK rivals. And it's also got the most loyal customers of any of its competitive rivals. It's also been extremely successful in terms of its financial performance. So in terms of its return per share, it's basically, again, outperformed its competitors over a long period of time. Now, what marks out this bank? And this is a key element of linking together this notion of how does one embed a purpose, problem-solving bank with this notion of implementing it in the business. A key element that Handelsbanken brings out is that the way in which banks are traditionally run is in a very hierarchical fashion from the top. And one of the reasons why they are run in this way is, and this again reflects an influence of regulation, is that in particular since the financial crisis, the boards of companies have been expected to take responsibility for the risks in banks to a far greater extent than was previously the case. And that has meant that the boards of companies have had to oversee risks that previously they had largely presumed had been handled elsewhere in the bank. So increasingly, control of banks has come to be dominated at the top. What Handelsbanken has done is exactly the opposite. It inverts control so that it's delegated right down to the individual branches to a point that the mantra of the bank is the branch is the bank. And by that way, it delegates responsibility to the branches and in particular the branch managers to make decisions about to whom they're going to lend, what products they're going to provide, what prices they're going to charge, and whether or not they can extend a loan. And the importance of that is it allows the bank and the branch managers to build up relations of trust with their customers in a way in which a bank that's run from the top simply cannot. Because what it does is it allows the branch managers to make decisions of, for example, whether or not I'm going to give you a loan, without having to pass it up the hierarchy, wait for a decision to come down, and then to have to say to you, terribly sorry, your loan has been declined. It allows the branch and the branch managers to look people in the eye and say, do I trust you? And do I trust what you're saying about your business proposition? And this is an essential element in terms of the bank being able to build up relations of trust with their customers. In essence, what Handelsbanken has been able to do is to recreate what was prevalent in virtually every country many years ago, local banking in the context of a large international bank. And it's therefore been able to build up relations of trust with its customers to a degree that other banks have not. And what underpins the ability of the bank to be able to delegate this authority down the organization is it not only has a clearly defined purpose, but it also has the values that underpin those purposes. So that the values and the culture of the bank are aligned with the purpose of putting the customer interest first and maintaining a low-cost base in the bank. So they instill the values into people in the organization. They then tell the branch managers to get on and run their branches as if they were standalone banks. Now, the significance of this is then in recognizing the importance of being able to create these relations of trust in financial institutions and between financial institutions, and in particular, small and medium-sized enterprises. One of the reasons why it is one of the fastest growing banks in Britain is that Britain used to have local banks all over the country. But those were then destroyed during the 19th century when banks failed and the Bank of England consolidated banks, and they headquartered in London, resulting in there being 5 banks run from London. And that completely destroyed this relationship between banks and their small and medium-sized enterprises, and has created a funding problem of companies in Britain that has persisted ever since then. And one of the elements associated with the decline in trust of banks in the UK is precisely the elimination of this personal relationship aspect, which Handelsbanken has been able to successfully retain. Now you might say, well, this is all very well, but surely branches are going completely out of use. Banks are closing branches all over the place to reduce costs. And this is being driven in large part by technology. In particular, it started off with cash dispensers, ATM. It then intensified with internet banking, and it's intensifying even further with artificial intelligence and fintech, allowing technology to substitute for people in, for example, evaluating the creditworthiness of borrowers. And so you might say, well, surely Handelsbanken is simply being competed out of business. And the answer is no. On the contrary, it's being able to reaffirm the importance it attaches to branches. And how has it done that? It's done this because it realizes that actually what's emerging is not that the branch is becoming redundant, but that it's the large, expensive, shopfront branch facilities, premises that really are not needed. All that you need is people, local people who know the area, who know the particular issues and problems that companies, in particular small companies, face in those areas, and can build up relations with our corporate customers. So it's closed its expensive high street premises, put people into little offices at the top of the block, and reduced the cost structure while retaining and indeed strengthening the branch relationship aspect of what it's doing. Now, the reason I want to emphasize this is that it brings out a very important issue about the impact of technology on the financial sector and the role of financial institutions in the future. Because it is quite clear that what fintech and artificial intelligence in particular are increasingly doing is to eliminate many aspects of what humans used to do in the past, in terms of, for example, doing routine credit evaluation. It's doing that in a form that means that that routine element can be taken out of what bank employees and investors in general have to do. And it allows bank employees to focus on what humans are good at doing. And that is to be human, to build relations with people, which artificial intelligence and no machines can do as well as humans. They try to replicate what human emotions are, but it's one thing to replicate it, it's another to be really human. So that is what allows Handelsbanken to delegate the responsibility to the branch managers to concentrate on looking people in the eye and deciding whether or not they trust and want to promote them. And the way in which Handelsbanken then earns these high returns for its shareholders is through these relations of trust. It builds long-term relations with companies. It doesn't simply sell products to companies. It grows its business as its corporate customers grow. Now, good though Handelsbanken model is and successful it has been, it is, though, still a rather high-end bank, in the sense that the customers of the bank tend to be at the wealthier end of the distribution. And so one should recognize that this is not the only example of a bank that has created a relationship arrangement with its customers. It's a feature of what is termed the German Mittelstand, and the way in which the German Mittelstand has been successfully grown, in particular in the post-Second World War period. The medium-sized, small and medium-sized enterprises in Germany have been funded on a very similar basis to the sort of local banking that Handelsbanken has created, through, in particular, what is known as the Sparkassen, the savings banks in Germany. And the savings banks have essentially retained that element of local banking, which, as I said, was a feature of Britain during the Industrial Revolution and basically turned Britain into the workshop of the world. It's gone in Britain, and I would suggest it's one of the reasons why Britain has plummeted from being the workshop of the world to being one of the most distrusted countries for its business leaders in the world. But in the case of the Mittelstand, it's been retained because, in part, of the way in which the Sparkassen have been regulated. Instead of consolidate and headquartering themselves in Bonn or Berlin or Frankfurt, what they've done is they have retained their local presence, but there's been a co-insurance between the Sparkassen, which when one Sparkassen gets into difficulty, they essentially get bailed out by the other Sparkassen. And that notion of co-insurance is a way of thinking about regulating banks is actually a very critical component in terms of retaining this notion of purpose-driven banking that can lend to growing purposeful businesses. Another country that's done this very successfully is the United States, where because of prohibition on interstate banking, regional banking has persisted in the US in a way in which it simply has not in the UK. But there's another reason why it's persisted, and that is because there is a regulatory body, the FDIC, Federal Depository Insurance Scheme, which provides precisely the same sort of insurance that I was describing in relation to specialised. It's essentially a co-insurance scheme for the regional banks across the US, so that when, as it inevitably happens, one region in the US goes down and the banks in that region fail, there's a way of bailing them out without simply forcing them to merge and move to New York or to San Francisco. So this notion of thinking about how a regulatory system, how a system of insurance can allow local banking to persist is an important element in thinking about how the financing of small and medium-sized enterprises can persist, even as financial markets grow in significance around the world. But it's not only in relation to banking that this is important. One of the features of Britain is it is one of the countries in the world with the highest level of inequality of earnings, of wealth, and of commercial activity around the country. As this slide here shows, a large proportion of companies in the UK are headquartered or based in London, the southeast, or the east of England. As you move away to the north, the proportion of businesses in the UK rapidly falls away. Now, what is striking about that observation is that not only is there this high concentration of business activity, as shown by the blue areas here on the map in the south and east of England, but also there's an extremely high concentration of financial institutions and financial investment on the equity side as well as the banking side in London and the southeast. So this slide here shows that of private equity and venture capital finance, approximately 2/3 of it is situated in London and the southeast, the blue, the light blue, and the brown area. And if one looks at the level of investments by different stages of investment, and in particular in relation to later stages of investment and growth capital in green on this graph, you can see that London and the southeast dominate. And just keep in mind this scale here, which is going up to £2 billion. And I go on to the next graph to show the rest of the country, where you see that I'm talking not in terms of billions, but at most in terms of hundreds of millions in other regions of the country. There is a vast concentration of equity finance from private equity, venture capital firms, and growth funds in London and the southeast. And the reason why there is this high level of concentration is that there is very little in the way of presence of financial institutions like venture capital firms outside of London. And this slide here shows the location, for example, of business angels. That is to say, wealthy individuals who lend to the startup of companies. And you can see that London and the Southeast accounts for approximately getting on to 60% of business angels in the UK. Now, this, you might say, is rather surprising, given that the UK has one of the most successful international capital markets in the world. Even post-Brexit, it remains as a major international capital market. But it's an international capital market that basically is not financing business outside of London and the Southeast. And there are continuous complaints about the fact that it's very hard to raise, in particular, equity finance outside of that very narrow region of Britain. And one of the contributors then, and a major contributor to the very unequal dispersion of businesses across the country, is the absence of financial institutions outside of London and the Southeast. What's the reason for this? The reason is this absence of the pipes that link this capital, global capital situated in the City of London, to cities in the regions. There aren't the people, the business angels or the private equity people, who can do what I was suggesting bankers have to do, to look borrowers in the eye and say, do I trust you? Repeated studies of financial markets show that there is a very strong relationship between the proximity of investors and borrowers to the provision of finance for borrowers, in particular for corporate. And in the absence then of those pipes to link capital to the people and to businesses, the capital doesn't flow outside of London and the Southeast. Now, what this is pointing to is the importance of thinking carefully about what are the factors that determine the way in which the financial sector operates and the degree to which there is an effective interrelationship between the financial sector and the corporate sector. And one of the elements that I think is really important in this regard is to recognize that regulation has a central role to play. And I want to illustrate this in relation to a very different type of financial system. Not in one of the most developed countries in the world, but in one of the developing countries in the world, and that is Kenya. And I want to illustrate it in relation to what has been the most significant element of financial inclusion that the world has ever seen, the fastest level of financial inclusion that has ever occurred. Still got a bit of time. How am I doing? I'm running up. We go on to 7, is that right? 6:30. 6:30. Okay, all right. I'll speak. Okay, all right. Okay, so this is this. Sorry. Yeah, no, absolutely. Yeah. I'll try and sum up very quick. Okay, so it's one of the examples of the fastest levels of financial inclusion that's occurred. Between 2007 and 2017, financial inclusion increased from 25 to 75% of the Kenyan population. Only a quarter had access to any form of financial product in 2007. By 2017, it was a dramatic change. And it all had to do with the use of mobile phones to provide mobile by which people could put money onto their phone, get an immediate signal that their money had been deposited onto their phones, and they could use this to pay for things and to transmit money to other people. It was a secure form of monetary storage. It allowed for the transmission of money between people and for it to be used for payments. It was a partnership between the private and the public sector in bringing this about, between the public sector in the form of the Department for International Development, DFID in Britain, working with two telecom companies, Vodafone and the Kenyan telephone company, Safaricom. The key element that I want to emphasize here is that regulation allowed this to happen. It stopped it happening until comparatively recently in most other countries because other central banks and regulators did not respond in the way in which the Kenyan regulatory authorities did. Most countries regulated mobile money as if it was banking and imposed prudential requirements onto mobile money. What the Kenyan authorities recognized was it wasn't a form of banking in the sense that it was subject to prudential risks and prudential regulation. The risks were associated with the telecoms. And so capital requirements were not required. And as a consequence, mobile money could be operated far cheaper than it would otherwise have been possible if it had been simply regulated as being a form of banking in a traditional sense. This is an illustration of how regulation, with the best intentions, can seriously undermine the way in which the financial sector performs its function in terms of problem solving. In this case, solving a problem of creating financial inclusion in one of the least developed countries in the world. And what I think is important to bear in mind is that the way in which we think about the regulatory system, both in terms of banking and in terms of equity, private equity, and public equity, is in terms of looking at it from the point of view of investors. In the case of banking, thinking about it in terms of providing protection to depositors and avoiding the risks of failures of banks in a systemic sense. And in the case of equity investments and private equity, avoiding the exploitation, in particular, of minority investors. And this notion of protection of investors has been the dominant consideration of the way in which we have structured the regulation of our financial systems around the world. What these various examples that I have been bringing out suggest is there is more to it. Banking and investment is a two-sided activity. It's about taking money from investors and giving it to those who can profitably use those sources of finance, in particular in the corporate sector, in the small and medium-sized enterprise. And the purpose of business and the purpose of banking and equity investment is to promote the use of those sources of funds as ways of stimulating purpose-driven corporate investments. And to do that, institutions have to build up close relations, both with their savers, but in particular with their borrowers, in such a way that they can form these relationships of trust. And one therefore has to think about the way in which the regulatory system operates, not just in terms of the traditional form of looking at it in terms of being about liquidity, risk transfer, in terms of credit risk transfer, etc., but thinking about it in terms of how does one promote problem-solving, banking, and other financial institutional investment. And what that means is a form of regulation that emphasizes not just capital adequacy ratios, liquidity ratios, separation of investment banking and commercial banking, narrow banking, and all of those forms that are the traditional recipe for financial regulation, but thinking about the role that regulators can play in terms of assisting financial institutions with building up the cultures, values, and the purposes associated with solving problems of others, of both not just their depositors and investors, but also their borrowers, their corporate borrowers, and their personal borrowers. And thinking in those terms gives rise to a very different form of regulatory structure from the way in which we traditionally think about it. And it comes back to what I was saying at the beginning, that ultimately business in general, but banking and financial investment in particular, are activities that are based on trust. And trust is critical to the successful performance of the corporate sector. And the success of the corporate sector in doing it depends on having a public sector and a regulatory system that is associated with and conducive to the successful problem solving of business in a way that then creates trust. And if we then think about the regulatory system in this way, it allows us to think about what I believe we need, and that is purposeful regulation. Purposeful regulation that supports purposeful financial institutions and purposeful problem solving and profit for businesses as well. Thank you.
Thank you very much for this. It's quite a good result, I have to say. Lots of very different topics, and but I found it very nice how you put them all together. So shall we go around? Okay, well, if you raise your hand, then please go ahead, please.
I just more than question, more a comment that now I'm doing fieldwork for my research, as I was telling you before, and it happened to me to find myself among like in events among people from like finance, from both practitioner like perspective and scholars. And when I try to approach them, to pitch them, to like try to talk to them about my research and maybe asking them an interview, I would tell them, I'm working on corporate governance and sustainability. And their reaction really surprised me because they were like, well, not my business, I don't have anything to tell you about. And this happens both with practitioners and even more often with scholars. And this is a huge problem because I remember when I was practicing in corporate M&A department, not in the banking and finance department, I was dealing all the time with shareholders. I was assisting them in shareholders meeting, in their like negotiations with board, in many aspects, and I was doing corporate governance practically. And so how come that when I approach people studying finance, they say to me that you don't know anything about corporate governance? And they say, I think this is sort of, it is connected with what you were saying, that maybe it's true that the regulation approach to this topic is too much like sectorial and doesn't really facilitate the dialogue between investors, shareholders, and companies in also like starting from governance.
Yes, I think you're absolutely right. And this is in part how the subject has emerged in economics in particular, that the financial sector is regarded as being very divorced from the real sector of the economy. And it's sometimes put in terms of finance is just the handmaiden of industry. Whether or not a bank lends to a company, well, that depends on whether or not the company is investing in profitable activities. If it is, then the bank will lend, and if it isn't, it won't. You know, it's got nothing to do with the bank failing to lend what it should be lending, things like that. So there's this notion that, well, we've got the financial system over here, which is doing all of these important things in terms of investment and looking after people's savings and insurance. We've got the real sector over here that's doing real things. but the financial sector doesn't really affect the performance of the corporate sector. And what I'm saying is that is absolutely wrong. It is the fundamental determinant of what drives the corporate sector. And the reason why Britain has been so unsuccessful over the last 100 years is because it has failed to link the two together. And it has brought into this traditional notion of what financial institution is, financial sector. So I absolutely agree. That is a fundamental defect, the way in which we've conceived of this subject.
Yeah, thank you very much. Yeah, thank you very much for this fascinating talk. And I think, yeah, you mentioned really several things that were absolutely interesting and fascinating. I especially found interesting your points on how the regulations shaped the banking system in the UK at the end of the 19th century, in the US, then also in Denmark and Sweden. And I also absolutely share your enthusiasm, if I may say so, for these social purpose-driven banks and governments. But then, for example, one point where I couldn't really follow the argumentation, it might be also because I don't know enough about the specific Kenyan case, but you emphasized very much this importance of personal relationships.
Yes.
Between the banks and the customers.
Yes.
And then in Kenya, it was mainly about this mobile
Technology.
which then, of course, I don't really associate.
Okay, right. And that's a really interesting point. Let me just go back to that, because I actually skipped over something quite rapid. Oh, yeah. I'm not sure I can. Anyway, I had a last line which I didn't refer to, and that is the importance of agents. Okay, because what M-Pesa did was it came up with a very innovative way of solving a problem. And this is a good illustration of a purpose-driven problem-solving institution, thinking about how to solve a big problem. So the technology is clear. You know, when you give money to an agent, you get an immediate credit on your phone. So you know that M-Pesa is not stealing your money because you've got an immediate record. It's not that you have to wait for a week to get a bit of paper from the bank saying that you've been credited. You get an immediate statement that you've been credited. But the problem is that Kenya doesn't have many bank branches. And what M-Pesa wanted to do was to operate separately from the banking system because that was too expensive. So it used lots of little agents, which are people who sit in kiosks all over Kenya, take money in, give people credits on their phones, and when they come in and they want to cash in on their credits, they give them money for the credits that they've got on their phone. But the problem with that is, well, how can you possibly trust these agents not just to steal the money? And so the way in which M-Pesa solved it was to say, right, okay, well, we're not going to have M-Pesa giving the agents money. The agents have to put up the money themselves. And then they get credits given to them from M-Pesa. And the way in which they allowed lots of relatively poor agents to be able to do this is those agents formed what are termed aggregators, groups of agents, which supported each other. And that way, they solved an agency problem. Now, how do you solve the problem of these agents stealing money? So this does allow, it created a personal relationship in the sense that the agents could be distributed all over the country to allow people to get cash in that very direct way without having to have a very expensive banking branch system, which would have completely undermined it. So you're right, it looks as if it's just a technology solution, but actually underpinning it is also a pretty innovative way of thinking about how do you solve the problem of the people who are actually handling the money.
Thank you for your presentation. I also wanted to connect to the last question regarding M-Pesa, which tells a lot more about informal institutions.
Yes, yes.
And what M-Pesa tried to solve was similar to what's now the crypto anarchist movement tries to do with blockchain technology and this
Yes.
to solve legal problems in technology and to replace trust in institutions with trust in technology.
Yes.
Which is what some
Yes.
scholars believe that
Yes.
when actually in reality there is no really trust in technology, but it's trust in the persons or the leaders that are running the
Yes.
are really still physical persons. Which is one of the major charismatic leaders in the blockchain technology. He sits on one of the Ethereum Foundation in Switzerland and votes or shares any input regarding the organization, even if he doesn't have a function within the organization, everybody follows. So I think that it's also the power that shareholders or investors can have into shaping an organization.
Yes.
That's something that we haven't cared about.
Absolutely. Absolutely. And that is precisely the point I was making about ownership and how ownership is critically important in this regard. Because however motivated the employees or the directors of an organization are in terms of solving problems, if they don't have supportive owners, controlling owners, they won't be able to do it. And that is why families, in many cases, do this very successfully, where in particular the foundation-owned firms, I think, have done it very successfully. But where it's simply just companies that are listed on stock markets, widely traded, vulnerable to hedge fund activists coming along and changing the ownership and the management of the companies, it's extremely difficult for those companies to commit to these types of things. That's why at the end of the day, my view is if one's really going to get this notion of purpose-driven business established as the norm, it has to be a matter of thinking about the legal framework within which companies operate, and in particular corporate law.
I have a question. Sorry. There was just a follow-up question to there, because I'm also working on these teams, and I find that there is another problem that is also from a private law point of view, and how to define, for example, digital asset or digital money, and if it's something that the regulator is missing in the sense to help the development of this kind of new intermediaries by defining, for example, as the UK is proposing, I think, defining digital asset as a third type of property, or something that, for example, the European Union is underestimating as a problem that could help actually the development of a new financial instrument, because everything stemmed from this mistrust with reference to from the 2008 financial crisis that brought all this blockchain technology together. But then you feel that from decentralization we came again to centralized, but we have this new type of property and so on that has to be somehow analyzed by regulators. So what do you think would be the necessary approach there?
Okay, so you're exactly right in saying that the property ownership of these new technologies and the property rights that they create is critical in thinking about the way in which they're going to develop and whether or not they're going to become trusted instruments. And I think the area where this is going to be of most pronounced significance, which block technology is an illustration, but I think it goes much further, is in relation to artificial intelligence. The use of artificial intelligence in financial institutions. Because what is emerging, that artificial intelligence is moving beyond just a means of analyzing data and providing advice to those in companies, for example, lenders, who can get a lot more information about the quality of potential borrowers from AI sources than they could in the past. It's moving to becoming a decision tree. Okay? In other words, it's substituting for human decisions. And that raises very fundamental questions about what is it that the objectives of those AI decision-taking systems are, and what interest do they have in terms of promoting the well-being of those that they're interacting with, as against just promoting the profitability of the organization. If therefore we end up with AI, as many people believe it's going to do, simply intensify a focus on short-term value creation for the creators of these machines, it could have a dramatically disastrous implication for the way in which the financial system operates. If, on the other hand, and this is where I keep on coming back to the importance of, in the AI context, it's talked about as being keeping a human in the loop. Okay? That you can have AI operating and collecting vast amounts of information, but a human has to, at the end of the day, be the thing or the person who makes the decision. Okay? And that is a feature that is not currently being built into the way in which, in particular, machine learning in AI is developing. And indeed, there's quite a lot of resistance from the AI companies to requiring this notion of a human being in the loop. But I think it's absolutely essential to ensure that these machines don't go astray.
Like validating nodes.
Absolutely, absolutely right. Validating.
So I want to build up a bit on what Elena said, because I had a bit of a similar experience with corporate governance. When I was a regulator working reforming the corporate governance code of Argentina. And at that time, everybody was riding the wave of the BlackRock ESG. At that moment, it was not called ESG, woke capitalism, as it is right now.
Yeah.
And I remember there was this presentation from an economist in my alma mater. In Argentina, well, economists tend to be celebrities. So there was this big, like, Thorsten will be a celebrity in Argentina.
But he's a celebrity. In Argentina.
A TV celebrity. So there was a guy that he came to talk about ESG. Right? So I posed the question. I was running the task force with the private sector. Why there was so much resistance if everybody was so much important? And he basically answered to me, because you are doing stupid regulations. You should not do these many things and let us do whatever we want. He said it in a less rude way, but that's what he conveyed, right? And I was shocked. So my question to you would be, because now we are riding a similar way in Argentina, that all you have to do is fix the macro, 9 months of fiscal superávit. Now we have to sit down and wait to become Switzerland. So that's what they are expecting. My question to you is, what is the role of macroeconomic and the macro policy, and also macroprudential policy on this framework? Because it has to go in tandem, I assume.
Yes, absolutely. So the macro policy is one that is focused on those risks that individual institutions cannot control themselves. So I made the point that Handelsbanken delegates decision-taking down to the individual branches and avoids as much as possible the increasing tendency to centralization. But it still retains control at the board level for systemic type risks and for risks that affect the bank as a whole. So, for example, this decision to close the shop fronts of the branches was one that an individual branch wouldn't take, but the central management of the bank did take. And it's appropriate then to retain decision over risks that affect the organization as a whole at the board level. The same goes when you think about this in relation to the system as a whole. So there are some aspects of the risks associated with financial institutions, which are, of course, systemic in nature. And one has to think about the best way of controlling those. But the point I'm making is that the response at that central level to those systemic risks has to reflect the underlying purpose of those institutions. And I'll give you an illustration. The UK's response to the financial crisis was to separate basically commercial and investment banking. It was called ring fencing. And that has done a brilliant job protecting the commercial banks from failure. Such a brilliant job that the banks don't do anything useful any longer. In relation to their SMEs They basically, they weren't doing much in the way of anything other than working capital lending. They're basically now doing only working capital lending on a very short-term basis to SMEs, usually looking for very significant amounts of collateral even when they're doing that. So they are not doing anything in terms of promoting investment, in particular outside of London and the Southeast, in long-term capital investment, intangible investments, innovation. They're doing very little in terms of that type of lending. So they become very safe from a depositor point of view, but largely useless from the point of view of the corporate sector, and in particular from SME. And that's a good illustration of how solving a systemic problem in a very effective way in relation to the risks of systemic failures has been solved in an entirely inappropriate way in terms of the purpose of those financial institutions.
I take one more question because I also have some, but yeah, Vanessa.
Thank you so much. So I studied a lot of shadow banking and its regulation. So this is going to be a super pessimistic view, because I'm really wondering, like, this all sounds fantastic, but is it implementable? And if you find such a regulation, on which level would it be? Because we know banking regulation is driven internationally and banks are operating internationally. And specifically because when we look a bit like how banks have evolved in the last 100 years and think of concepts like market-based banking, for example, we know that the banks themselves have fundamental problems to withstand market pressure. And I mean, you see that specifically in these very purposeful banks, you know, like this sustainable and ESG-like banks that really had tremendous problems with the low interest rate environment. So I'm wondering, like, you know, is it even possible to implement such a regulation? And who would do it? Would it be the banking regulators on like the national level, on the regional level, the international level, or would it be the banks themselves? And if it would be the banks themselves, like self-regulation, what would be their purpose behind it, like their idea behind it? Because at the moment, they originate to distribute and so on and so forth. So when you think about the banking model at the moment. So I'm just struggling to understand, like, you know, where we would see this coming from. And there's like one question I have actually with your example of Denmark. Is this development in Denmark driven by the business interest? So of this like large family owned or like this large fund, or was this regulation driven? Because this would be very interesting to understand where such a regulation like this would be implemented.
Okay, so let me answer that question first, because it might have an answer in your views. The answer is it wasn't regulation driven. It was driven by the fact that the founders of companies in Denmark often did not want to leave their businesses to their children, perhaps because they didn't have any of them, perhaps because they didn't have children who were really good at running businesses, or perhaps because they didn't like their children. For one reason or another, they didn't want to pass on their businesses to the children, so they put them into foundation. Okay? That was the original motivation. But what I'm saying is that the regulation and having a regulatory system which ensures that that form of ownership is not abused is critical in ensuring that it was a successful form of ownership and has helped to develop the Danish economy. That, I think, exemplifies very well what you're talking about more generally. But it comes back to the earlier question. You know, where does the regulation reside? It depends on the risk that you're having to deal with. If it's a systemic risk at a global level, one has to think about internationally coordinated regulation to oversee the banks. But what I'm saying is, a lot of the element that is specific to the bank is like that which is specific to a company. And that is to say, it requires not the imposition of uniform standards or regulation. It requires very specific forms of governance of those institutions which recognize the specific risks that they face. And that goes to the level, not just of the bank as a whole, but also to the regions and the localities in which they're operating. That's why this local element is so important. Because there's no way to say the head office can understand, if they're sitting in London, what it's like and what are the real problems that exist in terms of lending to companies in Yorkshire or whatever. Okay, so you need to have the control and the regulation, the oversight at the appropriate level. At the moment, we're trying to centralize too much, isn't relevant, and in fact undermines the operation.
Okay, may I have a couple of points, if I may?
Yeah, sure.
Comments. So first, I had to smile when you said the financial sector disconnected from the real sector, because I mean, in economics, as you know, the core finance and growth literature has basically argued that the finance sector is there to support the real
Yes.
sector, not to be separate.
And you and I have both contributed
Yes.
to exactly that literature to make, but we had to make that point. We had to get that point because it wasn't the traditional way of thinking.
And also, again, having lived in London for 8 years, there seems to be a very different view about the financial sector in London specifically, which is what I call the financial center view, which is the financial sector as a standalone sector, where London, because of its history, blah, 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 has a certain comparative advantage, and that we focused on. But it's just, I guess it's, then you can also argue, is it actually the reason why we are in the UK as we are, because there was this focus on building a financial center in the late 1980s after the Thatcher reform basically pushed certainly industrialization to a certain extent. So is that maybe just also historically kind of determined, and kind of a side effect of this was that these small local banks basically disappeared. Not the purpose of it, but
oh no. This is not Margaret Thatcher 1980s. This is 1880s.
Oh,
and the collapse of the Bank of Glasgow.
There were smaller banks still in the 1980s. Wasn't it a demutualization movement in the 80s, 90s?
No, well, there was the demutualization of some of the mutual institutions, but no, we had basically ended up with 4 large banks concentrated in London on the commercial side.
But then, and now I'm going to push back a little bit on this, because the long one, when you talked about foundations, when I said kind of a banking economist, I hear foundations, I always think about the Spanish cajas, because they were supposedly owned by foundations, and we know that went horribly wrong. Although the issue was a little bit different, because there was not really any ownership, there was no governance, and there were politicians who were hiding behind the foundations. So anyway, but
okay, just before you come on to your next, let me just say that is why Italy illustrates precisely why, in response to your question, you have to have the right regulation of the foundation, because Italian foundations are a disaster. They're publicly controlled, and they therefore have been associated with much abuse.
Now, on the regional local banking, now I know coming from Germany, of course, there have been always kind of seen as supporting the small enterprises, SMEs, Mittelstand, and so on, and maybe also similar in the US in certain times. But there is also a dark side to it, I would argue. I mean, in the regional banking under the branch restriction period, basically also had higher costs, lower efficiency, and I guess largely just shows that the branch deregulation actually had positive effects. Now, whether these effects maybe were too good to be true at some point, that's another question. But there is, of course, regional banking has the disadvantage of kind of leading also to certain stale structures. And I can also see this in Germany, where it's there's a strong connections between the savings banks, the cooperative banks, and the political elite. Sure, on the local level, the regional level, all the way up to federal level. I mean, I like to tell this anecdote that Helmut Kohl, when he was chancellor for 16 years, one of the reasons why he had a strong power base is because he knew every single local party leader in Germany, and he knew their families. Now, these people also sit on the boards of the local savings bank, so you can see the direct link here. That's not helpful. So I think that one of the problems, and given that links back to the kind of whole bank bias debate, is that having these strong politically connected local banking system can also hold back innovation in an economy. So that's just one thing I kind of push back a little bit. Maybe one more point I want to make. So I take your point on the regulators should look beyond. I mean, I'm going to rephrasing this now. Regulators should, or supervisors actually, I think, not regulators. Supervisors should look beyond capital equity ratios, pure stability on the kind of the numbers, the ratios, You should look at governance, you should look at business models. But if you talk to people at the ECB bank supervision, they would agree with you actually.
They would.
But
Yeah.
they focus still on stability.
Yeah, no, absolutely. I'm not suggesting these other things are irrelevant. But I'm saying they need to be complemented by much more that's done in relation to what drives a successful bank.
Yeah, although, I mean, then of course, if you say they should also look beyond stability, then we get to the problem of the Tinbergen principle, right? Can really one institution focus on two objectives? I mean, in Kenya, for example, the central bank doesn't.
No, but I think this is,
but
I would argue that this is critical to enhancing stability as well, because if you, as we know, from what's happened over the last year or so, and one large banking failure, that can easily create this. And coming just back to your Mittelstand, I agree that the Mittelstand has a lot of issues associated with its political connections. But bear in mind, it's probably better to have a somewhat inefficient banking system that supports the Mittelstand than having a banking system that doesn't do that at all. Okay, so I think it's better. And furthermore, it has played a very important role, as I said, in the US as well. And the way in which the US has got on this problem is savings banks are important, but they're not the only part that's important. So too is the equity system, and it's a much more decentralized venture capital system than it is.
okay, thank you for this. I think you're right, unless you have any final words.
It's
Right.
fine. I mean, many of the questions.
I have a question online, please.
Okay.
Can it?
Yes.
Right.
Yeah, I actually wrote it down. So I mean, Colin, that's very interesting. Thanks for the presentation. I'm just wondering, given that the purpose-driven approach is very attractive, why is it not mainstream? And how do we make it mainstream in a way? How can we encourage society to adopt it?
I think I mean, that's a very good question, Karen. And I think the answer is that we need more evidence in this area that it really does work. And we need more people to be putting forward the notion that purposeful banking and purposeful financial institutions and purposeful financial regulation are critical to the success of economies. It's a bit like the observation that Torsten made, that one had to do quite a lot of work to convince people of the relationship between the financial sector and growth of economies around the world, because that's not the way in which people have thought about it. And that changed people's views about financial institutions in very profound ways. I think we really need a greater realization of the importance of these issues and evidence to demonstrate that where it's done well, it's often incredibly significant in terms of both the stability of financial systems and their performance in relation to the economies as a whole. So that would, to my mind, be a critical part of this.
More research to be done. Thank you very much, Kevin, for this. I think with this, we close. Thank you again for this.
Thank you. Thank you very much.